The long weekend is over, starting this week how we ended last week with declines. 30 minutes ago into the start of cash equity trading, I'm Dani Berger. Matt Miller is off this week. Bloomberg Open Interest starts right now. Coming up on the show this morning, Warner Brothers reopens talks with Paramount, a move that could set the stage for another bidding war with Netflix. Activist action, Starboard targets TripAdvisor, Elliott builds a major stake in Norwegian, and Jana pushes for change at Fiserv. Plus, Anthropic and Pentagon hit a snag in contract talks over mass surveillance and security concerns. All right, some of the stocks we have our eye on in the pre-market trade. It's the deal that won't go away. It's Warner Brothers and Netflix, and now Paramount is back in it. Warner Brothers reopening negotiations with Paramount Skydance. Remember, Netflix already struck a deal with Warner Brothers, but Paramount has vowed to pay the $2.8 billion breakup fee. They now have 7 days to give their best and final offer. Let's discuss it with Bloomberg Tech co-host Ed Ludlow. Ed, here we go again. Another bidding war, I guess, we have on our hands.
Yeah, at least there's a sort of chronology to this, which is, you're right, it's a 7-day waiver through February 23rd. The waiver comes from Netflix to Warner Brothers Discovery so that they can review any updated Paramount bid. Our understanding is that one of the Paramount bankers went to Warner Brothers Discovery's board and said that Paramount would be willing to go up at a minimum to $31 a share, an increase of $1. Remember, they want to buy the entire thing, and we can get into the other specifics. But they have 7 days to do something, and like the indication from the reporting is that, Paramount has not yet made its final offer, and you're absolutely right in the outcome. So let's say Warner Brothers Discovery says, okay, yeah, that's a much better offer, and they decide to terminate talks with Netflix, then Netflix gets the fee. But at least the clock is on.
The clock is on, Ed, but is $31 enough to move the needle? As you just mentioned, that might not be their best and final. What is it going to take for Paramount to actually be the attractive bidder for Warner Brothers?
Part of this is that the 7-day waiver also gives Warner Brothers Discovery and Paramount time to talk about the issues that the boards had with the Paramount bid, which were wide-ranging. The valuation, right, remember, Paramount proposes to buy all of Warner Brothers Discovery, including legacy network and cable, whereas Netflix would only buy the studios and the streaming business, spinning off the legacy networks into a standalone company. And that dollar, basically, Paramount had, to the market's mind, undervalued the legacy networks and given them an essential valuation of like near zero, which people either agree or disagree with. So that will be a part of it, along with, there is still in the background the specter of antitrust on both. But, Netflix, again, this morning issuing its own statement saying that, they feel very confident in their existing bid.
I was going to say, Ed, it feels like we've gotten caught up with the bidding war and kind of forgotten about what regulators are going to do here. The president himself had expressed skepticism on Netflix and specifically zeroing in on CNN. Does either side seem like it has a better chance of getting through regulators, of allowing this to pass antitrust hurdles?
Again, where we've got with it is a Capitol Hill hearing, which does not amount to regulatory review, right? It's an opportunity for lawmakers to pass view. And in that case, both potential combinations are under the microscope. The only other thing is to say, well, how has industry viewed this? And if you go back to Disney's earnings, Disney's CFO, also weighing in, well, Warner Brothers Discovery and Netflix would be very large. That's few words, but the insinuation being that, that would need as much review for just the studios and streaming X the legacy networks as the whole enchilada would if it were Paramount. We just don't know. It's codified, right? There is a precedent and rules-based approach to antitrust in this country, and that's, until the deals proceed, we don't know.
Ed, thank you very much for your reporting on this. Bloomberg Tech co-host Ed Ludlow, who will be covering more of this at 11 a.m. on the Bloomberg Tech Show. Elsewhere, activist investor Elliott has built a stake of more than 10% in Norwegian Cruise Lines, with plans to turn around the struggling cruise ship operator, releasing a letter on that just moments ago. Bloomberg's Crystal Seed joins me to discuss more. Crystal, what do we know about the stake that Elliott's taking?
Elliott is here pushing for a board overhaul. Norwegian Cruise Line is a really interesting company because it's one of those companies that were hit really, really hard during COVID. And then when you remember the whole revenge traveling, they really did come back. And it's something probably that had been looked at in the 2019 era where there were a lot of problems with cruise line, the way that people travel were different, but then COVID kind of stalled some of these activities. And now you're finally seeing activists are coming back saying that this can be improved. There could be monetization, there could be value creation, and most importantly, board overhaul at Norwegian Cruise Line.
There's a lot of activism news this morning. Some of it varies between reports and confirmed, but from Starboard, from Jana Partners, looking at TripAdvisor and Fiserv respectively. Crystal, is something in the water at the moment, or is it just because we're starting to approach the start of proxy season that we're seeing more of these reports crop up?
I think it's a little bit of both. Definitely the seasonality here makes sense. Like you said, the proxy season is about to start. A lot of companies that have kind of April, May, June voting season or annual shareholder meeting calendar are going to have a board director nomination opening in the coming weeks or even like now. So you see the activists take aims now just so they could sharpen the tools and see if when the time comes, if they think it's necessary to nominate directors. And more importantly, that's just been, sell-off kind of everywhere. TripAdvisor is one of those, names that have been looked at in the past. Fiserv is kind of a hedge fund hotel. So you do see a lot of these kind of between like market value and seasonality of corporate calendar. This is probably a really good time for activists to come out and attack.
How much of this do you also think is about the return of M&A and private equity being more active? Because I'm looking at Starboard, for example, what they're doing. They're pushing TripAdvisor for an outright sale. As part of this, because activists maybe can have an easier time of finding buyers for some of these assets.
Yeah, actually, that's a really great point. And I want to point out two other deals today that also got announced. Massimo Danaher that got announced. Massimo also had been a target for activists. Politan Capital had been there for a long time. And then you saw that Genuine Parts announce a split today, which we reported, and Elliott had been in that company and involved for a long time. So you do see activism, leading to M&A has always been a bit of a thesis. And like you said, with the return of capital, kind of the availability of capital with private equity player coming back, you definitely will see activists pushing more aggressively for M&A thesis versus the operational changes or leadership management changes in the past year or so.
Crystal, thank you so much for bringing us this reporting. That's Bloomberg's Crystal C. And tune in, by the way, to Bloomberg Deals. The show airs tomorrow at noon on Wall Street. It airs every Wednesday at noon. So a show you don't want to miss. We might just talk about all the deals that Crystal was mentioning. We're also closely following the meteoric rise of CEO pay on Wall Street. CEOs at top banks were paid at least $40 million last year. Their total pay surpassing records set both in 2006 and 2021. Bloomberg's Catherine Doherty reported on this and joins me now for more. The 2006 compensation analogy, I think, is an interesting one because the banking environment was so different then, and you could have banks being more aggressive. What does it mean now to have pay that rivals those levels, if not surpassing it?
Yeah, 2025 was a banner year for the banking industry. So that's why you're seeing these CEOs compensated in the way that these levels, they're surpassing records that were set in 2006 and 2021. So we're really at this new era for at least the banking industry and across finance, really. You have both record market revenue that's coming into these big banks. The trading desks, both in fixed income and equities, have benefited from the volatility. You've seen a resurgence in M&A. So the CEOs, and of course, there's other businesses beyond just the core Wall Street operations. There's the consumer businesses and there's wealth management. There's so many other aspects that a lot of these CEOs, when we're talking about the big 6 U.S. banks, it's not just the trading and investment banking that is increasing their profit share, but it doesn't hurt.
Does it even just boom from here, considering there is some expectation that this is a White House that's more friendly to the banks and more friendly to regulation? that they'll allow for an even widening out of profits from the banks?
I do think that 2026 has been a pretty positive year thus far, with a lot of question marks about what's ahead. So there's still some uncertainty with regards to how tariffs are going to play through of some of the smaller businesses, and that could end up hurting the consumer. You hear the CEOs, they're saying that right now the consumer is healthy, but in the future, they're still looking out for signs that stress might start to show up, whether it's pulling back on spending. You might see that discretionary spending starts to change. These are all signs that we haven't really seen in terms of showing cracks that need to be thought about or worried about at the moment. But this is really too early to tell whether or not a year from now we're going to be having the same conversation, saying, are the CEOs receiving an even a bigger compensation in the form of not just their base salary, but it's their bonus at the end of the day that is shaping up to be quite large.
Yeah, it would be super awkward if they got paid this much and then everything cracks. That'd be unfortunate. Catherine, thank you so much for joining us. Catherine Doherty on the latest on banking. Let's get a check on your future market this morning. About 20 minutes to go until the start of trading. We are down about 0.25% for the S&P. The NASDAQ underperforms after 3 consecutive weeks of losses, down 0.6%. Russell 2000 underperformance not as bad as the equal weighted index is just inches away from a new record. There has been somewhat of a broadening out. Staples, utilities, all of those safety type sectors have been doing extremely well, just giving you a sense of where sentiment is in this market right now. As for some of your other movers in the pre-market, healthcare manufacturer Danaher will buy medical technology company Masimo in a $10 billion deal. Crystal was just talking about this. Also, activists involved in Masimo pushing them to a sale. ServiceNow CEO has canceled plans to sell shares of the firm. Instead, Bill McDermott announced that he will buy $3 million shares of ServiceNow, which has gotten beaten up in the AI software sell-off. Shares are up nearly 5% this morning. And Anthropic partnering with Infosys to bring AI products tailored to specific sectors, including telecom and financial services. Those shares up 3.5%. Coming up, we're going to talk more about Anthropic, specifically their clash with the Pentagon over how its AI can be used. We're going to explore what it means, the future of AI in the military. Not the most comforting topic, I suppose, but stay with us for that after this commercial break. Let's get to high interest, a look at what's making headlines around the world. Iran said its diplomats are prepared to stay in Geneva for days or weeks to finalize a nuclear deal with the U.S. According to Iran's state-run Press TV, negotiations are expected to continue in the near future after the two sides return to their capitals for consultation. Meanwhile, the Islamic Revolutionary Guard Corps has resumed Navy drills, which would partially close the Strait of Hormuz. Oil prices, little change over the past 2 days. Meanwhile, Josh Kushner's Thrive Capital just raised $10 billion. That's its biggest fund ever. It also doubles its last raise. The heavily oversubscribed Thrive X will double down on artificial intelligence, space, robotics, and life sciences. Thrive's high conviction bets on OpenAI, SpaceX, and Stripe have paid off big, and the firm says the AI boom is just getting started. Speaking of the AI boom, Anthropic is arguing with the Pentagon over how its AI can be used. The AI company wants rules that would stop its chatbot, Claude, from spying on Americans or developing weapons that can be deployed without a human involved. The Pentagon says it should be allowed to use AI as long as it doesn't break the law. The fight could shape the future of military AI deals. Let's dig deeper into this story. We're joined now by Mandeep Singh. He's the global head of technology research at Bloomberg Intelligence. Nothing to make you feel like end of times doomsday, like an AI military story. Just how involved, because I know already you have some military suppliers like Palantir doing stuff like this. What is the crossover, the relationship right now between AI and the U.S. military as it stands?
Yeah, I mean, look, Palantir was using a lot of data and they were visualizing it using the GPS coordinates. LLMs give you another dimension to that intelligence layer where you can basically query trillions of data points to find that needle in the haystack. And in this case, you could apply that to surveillance. You can apply that to use cases that go beyond, just security in terms of the level of details it can go into. And look, things are like that are already happening in China. When you look at, how they are building their drone technology, how they are doing their surveillance, a lot of these are being implemented over there. So I think that's where the government wants to really leverage the LLM companies, because the likes of Palantir, yes, they gave you some benefit in terms of the use of data. LLMs give you the ability to interpret that data in a totally different way.
There was, I believe it was a journal story also talking about how the administration is trying to push into robotics to keep up with China. Are we going to get in this place where, yes, everybody wants guardrails, but it's a government that kind of says, forget your guardrails. We need this because of national security interests, that we have to keep up with China, because even if we put guardrails in place, China's not going to.
Yeah, and look, we've always had backdoors with software companies, when it comes to government specifically and national security interests. So in this case, the fact that obviously in a geopolitical context, this is huge. And LLMs are trained on data. So we have already used all the data that's available on open internet. The drones or the robots allow you to capture new types of data. Obviously, you have to look at the end goal in terms of what you're trying to accomplish around surveillance. But there's no doubt that technology can be used where you capture the data using drones, and then you mine it using LLM technology.
Well, okay, something like a Palantir, I mean, we're not going to be interacting as everyday consumers with Palantir every day. Anthropic is a different story, though, because they want everyday people to be using Claude. So does Anthropic need to approach this differently for fear of backlash against an American populace or a global populace if there are concerns about what they're doing with the military?
Yeah, you're right. Anything that's consumer-facing, I mean, whether it's Claude or OpenAI or Gemini, you're learning a lot more about individuals when you have a consumer-facing technology. Same thing with enterprise, but you're doing it at a completely different scale when it comes to consumer-facing products. And so from that perspective, you've got a lot more data when it comes to consumer usage and how they're using and their personal information if there is an AI agent attached to it. So there's certainly that aspect.
I guess what's the bigger risk? That sort of backlash or losing a government contract? Because presumably these things are very valuable for the companies too.
They are, but then Anthropic has talked about their AI constitution and guardrails from day one. That's been their big differentiator. So they probably will do it, but they will do it, in accordance with the guardrails that they have.
But can you also say, okay, who cares if Anthropic has guardrails? If OpenAI is not going to, are they just going to miss out and we'll still get to AI dystopia regardless? Yeah,
look, all these models have their sort of capabilities where they're really good at something. Obviously, Anthropic models have proven to be good at, coding agent and that sort of functionality. So that's where, just because Anthropic is not doing it doesn't mean OpenAI or Grok would be able to fill in that gap, because these models have their layer of intelligence where they really differentiate themselves.
What did you make of the news of Anthropic partnering with Infosys and starting to build more of those applications for different industries?
I mean, these companies have to look for distribution, and IT services is a big industry. So you can't have an army of people deploy your LLM. Even if you have the best LLM, it has to interface with existing software. So that's where a company like Infosys or any of the IT services companies, Accenture, et cetera.
Also argue that this doesn't necessarily take away from jobs, because when you have these integrations, you need people over the top doing the things and giving it the right prompts and all of that. Doesn't this, in some ways, maybe, create more jobs? I'm trying to look for something optimistic after talking about AI and military use.
I think there is a bridge that they have to cross when it comes to automation, where you really need the software to interface with the existing paradigm and the way things are done in the world right now. And that will require a lot of people who have an understanding of business processes. So I think they're doing the right thing by partnering with services companies.
Mandeep, thank you so much for joining this morning. Always a pleasure. That's Mandeep Singh of Bloomberg Intelligence. Coming up on the show, Invesco's Brian Levitt sees the rotation from AI stocks as a healthy foundation for broader market gains. He's going to be joining the show next. Stay with us on Bloomberg Open Interest.
The uncertainty in AI suggests that that entire trade is going to remain challenging. And meanwhile, I think investors will continue to go basically from the virtual theme to the physical theme. They're getting confused with all the digital technology, and they're going back to the old-fashioned analog world, the physical world.
Dani speaking on surveillance. Let's add to that conversation. Joining me now is Invesco Chief Global Market Strategist Brian Levitt. Brian, great to see you this morning.
Nice to see you too.
What a ride it's been over the past 2 weeks. I think easily over $1 trillion in equity market cap has been erased because of the AI concerns. It's hit basically every single industry. How are you viewing it right now? Are you finding winners, or is this a market you want to stand on the sidelines until we get any sort of clarity?
Yeah, and yet the market is a stone's throw away from its all-time high.
Yeah, that's a weird part of this too.
It is a weird part of it. So it's really all been this idea of rebalancing portfolios, and we knew that investors had gotten heavily concentrated to the big tech sector, and parts of it were overvalued. And so what you want to do is build a better value portfolio. The challenge has been for a while is where's the pickup in economic activity, where's the policy support. So the good news is this is all coinciding with fiscal stimulus in a lot of parts of the world, potentially more monetary policy easing in the United States. So what it's doing is it's shifting markets over to things that you would view as more cyclical, even semiconductors remaining a part of that.
Well, one analogy I've heard a lot, though, that maybe sprinkles some cold water on that is a repeat of 2000s, not necessarily in the tech bubble, but when you have the market leadership disappear, sometimes you can have other things come and take its place. And we saw that for about 6 months around the bubble burst of the dot-com bubble. And then everything, and then gravity hits and everything falls if you don't have that pillar. Is it a problem if you have a rotation at the same time tech is falling? Do you need that to play along in order to not see a wider sell-off? It's
a great analogy. The challenge is 2000, you had much higher valuations. You had stocks that had really deviated meaningfully from their fundamentals. So that's a bubble. I don't think what we're dealing with here is a bubble. And one of the things I think investors could look at is you've seen pretty big moves in parts of the tech space, some of the AI trade. The world hasn't collapsed. Yep. Household net worth is still near an all-time high. This isn't a bubble. You have some companies, and I don't want to always,
Brian, just hold that thought because we've got to go to commercial break. We'll continue this conversation. Brian Levitt's going to stay with us after the opening bell. Just seconds away until the start of cash equity trading. I'm Dani Berger. Matt Miller is in Disney World hanging out with Mickey Mouse somewhere. Here's how we stand in this market. We had a decline last week, the worst decline of the year. We're headed for another one, at least so far today, down 0.25% for the S&P. NASDAQ, that underperforms 3 weeks of declines for the NASDAQ, the most since late last year. And the Russell 2000, not as bad, still down about 0.25%. The bell ringers, we got USA Today. That's wonderful. Down at the New York Stock Exchange, they are ringing the bell. But the most important thing is this little guy or gal here, this dog. I mean, that's the star of the show. 21 shares of crypto company. I believe their ticker is T-Dog. So why not have the Doge mascot brought with you? Like, what a well-behaved dog. I want to interview them just so we can talk to that dog and look at all of his glory. Anyway, some of the stocks that we were watching this morning. We're watching the latest drama between Warner Brothers Discovery, Paramount, and Netflix. Warner Brothers has reopened negotiations with Paramount Skydance. Netflix already struck a deal with Warner, but Paramount has vowed to pay the $2.8 billion breakup fee. Netflix says that Warner Brothers should keep in mind that the risk that comes with Paramount's $84 billion of debt. So that's the latest there. Let's get back to these overall markets. Let's get back over to the desk where Invesco Chief Global Market Strategist Brian Levitt is still with us. So Brian, we were talking about this idea of like where valuations stand and how maybe it's not necessarily an AI bubble. So valuations, are you comfortable with them, of where they stand for the big tech players that you can continue to add? Especially after this most recent sell-off?
I would be very selective in it, but there's certain companies that are going to grow at a pretty significant clip or generating free cash flow and are now trading at much more reasonable valuations than they were even a handful of weeks ago. What I also like is this ability to rotate into other parts of the market where valuations are not as excessive, into places like mid-caps, into non-U.S., you need a catalyst for those things, and for 15 years we didn't have much of a catalyst. short of maybe 2001. Or 2021, I should say. But what we have now is improving economic activity, fiscal stimulus, and a weaker dollar for most days.
If we are going to see outperformance led by the stimulus coming in, why is it then that things like utilities and staples have done so well? Because that just feels extremely defensive positioning from this market.
Yeah, there's some cross currents going on here. You also see treasuries rallying pretty significantly. So there are mixed signals. Gold up, treasuries rallying, but at the same time, equal weight, S&P 500 near an all-time high. So, and you've got energy up significantly, industrials up significantly, semiconductors. So there's cross currents. It's one of these moments as an investor, you have to look through all of this and say, what are the signals that I believe in most? My opinion, I've got credit spreads still tight, tells me the cycle's likely to continue. I've got leading indicators picking up. It was only a couple of weeks ago we got the ISM Purchasing Manager Index at 52. That's expansionary territory. New orders within that survey rocketed higher, and prices paid was relatively flat. To me, that's a conducive backdrop for risk taking.
The whole narrative, though, that like AI is going to disrupt everything and it's going to take jobs and it's going to replace things, it feels like it's been a very Wall Street narrative. What is the risk that it becomes a Main Street narrative, that some of the economic boom or at least uptick that we're expecting has a ceiling on it from people who are scared they're going to lose their jobs and start saving more and stop spending as much as
You're
they have
seeing
been?
it in surveys. I mean, some of the surveys on employment are about as bad as they get. They're like near recession levels. And yet, if you go out on the weekends, everything is packed. Right? You can't get into shows. You can't get into restaurants.
Yeah, but maybe that's a New York thing, Brian.
No, yeah, I travel this country.
Okay.
So I try to make it very clear that that's not just a New York thing. I see
You're not
it
in the bubble.
I hope I'm not in the bubble. I mean, the reality is household net worth's near an all-time high. So people are feeling good. The unemployment rate is still historically low unless your age is 15 through 24. So my thought on this is that you want to be a shareholder because corporate profitability to the number of employees just keeps climbing. I also think we're probably overstating, at least over the next year, what AI is going to mean on employment.
That, I think, is so important because how are we even going to know how this thing shakes out a year from now, 5 years from now? I mean, we're talking about such big concepts. Can you actually have conviction in any of the AI disruption at this point? Whether it be on one side that the companies are spending too much or the other side things are going to get disrupted, how easy or difficult is it to have really strong opinions about that?
Well, there's some challenge around the timing of the investment versus when revenue appears for a lot of the providers of it. So I think that's a challenge. What we do know is that the investment is going to continue. You see it in the Amazon report. You see it in the Alphabet report. So, Dani coming into this segment talking about the physical of it. We know the demand for chips is going to be there, for memory is going to be there, for the build out of the data centers is going to be there, the support of the industrial businesses. So that's all part of this rebalancing. It was my idea around, or what I was saying earlier, that you want to be able to rebalance, but you need growth somewhere for there to be a catalyst for what had been better value in the market. And that's a likely better way to play it. The other thing is, who are the businesses that are going to benefit from all of it?
How are you viewing that, by the way? Which businesses benefit from this?
I think there's going to be a significant number of business. I think companies across the S&P 500 are going to benefit from it. One of the great examples that I was thinking about recently is just think about glass, which is an old economy type of business.
Right.
If you're going to put AI in everything, think about the amount of glass you're going to need, right? To robots. New phones, car, right? So these are the types of things that I don't think investors are thinking about. I also look at it, hopefully it's not coming for my job yet. I also look at how much more productive we can be. That MIT study said it does 12% it can take 12% of the workforce. No, that's not what it said. It said it does 12% of your job. And so, yeah, it probably does do 12% of my job. What does that free me up to do? What opportunities does that give me to see more clients, to help solve some of the challenges that they're facing? To me, that's really exciting.
But are there companies out there who are kind of like chasing the shiny future of AI and it's a distraction? And maybe they're letting go employees prematurely, or they're investing money in AI where maybe it should be invested in other things. Maybe the old software is where they should be investing. Is there an issue where they get too distracted and maybe it's a shareholder base that's forcing them to do this when the core of the company perhaps it would be better spent concentrating on other things?
You're not seeing it significantly in the data. So if you look at jobless claims on a weekly basis, the number of people filing for unemployment still remains relatively low. So you're not seeing hiring to the extent that you would want to see it, which is probably why you get Fed rate cuts. But you're also not seeing jobless claims pick up significantly. So businesses are kind of caught. A lot of the investment being done by cash flow generative businesses, right? The big mega cap growth names. And for years, we've been wondering where that investment goes. Now, as an investor, you need to look at the so-called hyperscalers and say these were companies that had near monopolistic characteristics and were not making big investment. Now they are, and they're all competing in the same space. So you may want to debate more than you had in the past, the Mag 7, the so-called monolith that all goes up and down together, which of course it doesn't. That's all part of the rebalancing, thinking about businesses that are going to utilize this rather than those that are making substantial investment.
So it sounds like maybe a healthy rebalance that's happening, a healthy rethink we're having on this market.
I like the S&P 500 equal weight near an all-time high, right? To me, that's better than 2024. There's an irony in it in 2024 when only 7 stocks won. People didn't like that either. So now you're having broader market participation, different sectors, non-U.S. commodities. To me, that feels healthier.
And I believe there's some nice Invesco funds where you can play those trends too. So.
What a coincidence!
What a coincidence, Brian. Thank you so much for joining
My
this
pleasure.
morning. Great
Thank
to
you.
see you. That's Invesco Chief Global Market Strategist Brian Levitt. Let's get a check on your equity market right now. About 9 minutes into your trading day, we're just barely hanging on to gains. So a nice little turnaround from the pre-market session where it was losses after last week's losses. Financial companies having a very, very strong day. So Apple is at the top. I should start out with that, up 1.3%. Those shares have been beat up as of late. JPMorgan, Berkshire Hathaway, Citigroup, Visa, Wells Fargo, Bank of America, Goldman Sachs. So yeah, you get the flavor. It's a good day if you are invested in one of the Invesco ETFs on financials and banks. Meanwhile, to the downside, Alphabet, Tesla, Microsoft, Alphabet, NVIDIA, I said Alphabet twice. Forgive me, it's listed twice, the 2 class shares. So some of the big tech is not doing well today. Caterpillar, the old economy company, that's down 1.7%. If you look at the indexes, as expected, it's going to be financials at the top, up 0.8%. Utilities have been on an absolute tear. That sector has done so well, trading around new highs, as is Staples, which is just barely hanging on to gains. It is materials, which is underperforming alongside energy after the volatility in oil markets over concern about those talks in Geneva happening with Iran. Coming up, Paramount is back in play for its Warner Brothers bid. We're going to discuss of what that means next. Stay with us. This is Bloomberg. Get a check on your equity markets right now. 12 minutes into your trading day, we had a little bit of gains. Now it's a little bit of losses, down 0.2% for the Nasdaq after 3 weeks of consecutive declines. What happened to the broadening out? The Russell 2000 that underperforms this morning, down 0.3%. The equal weight just touching new highs. A lot of the safety sectors had been doing well. Financials outperforming this morning, but a lot of wavering as we stand. All right, let's get some top calls to analyst action that we are focusing in on. First up, Citi downgrades Bath and Body Works, saying that the core business remains weak. The analyst there sees a 5th straight year of sales declines and warns that a planned Amazon launch later this year could make it tougher for the company. Next up, UBS is upgrading Southwest to buy, saying the airline has more upside from its extra legroom, assigned seating, and checked bag fee plans than previously expected. UBS says that the airline could see significant profit growth as the strategy takes hold, shares up 4.25%. Finally, Rothschild and Redbird downgrades Warner Brothers Discovery as the company reopens sales talks with Paramount for a potentially higher bid, a strange downgrade considering maybe this means they get more money. Shares are up 2.7% off the back of that story. And let's stick with the developments in it. Bloomberg senior M&A reporter Michelle Davis broke that story over the weekend, and then we get confirmation. I'm pleased to say that she joins us now. Michelle, thank you so much. So what is the latest twist and turn in this?
So it's kind of the moment we've all been waiting for. Warner Brothers has finally said, okay, Paramount, we will engage. And so basically, Warner Brothers was able to negotiate a waiver from Netflix. They still have this signed agreement with Netflix, but Netflix has said, if you want, you can talk to Paramount for the next 7 days, see what you can get out of them. And so that's what's going to happen over the next 7 days. It's kind of this make or break moment. Paramount has been teasing for months that it has more to offer, that its $30 a share offer was not its best and final. Now's the time for them to really show that they have more to offer.
Forgive my ignorance. How usual is it for Netflix, a company like this, to grant that waiver and say, go off and talk with them?
So it's something that was negotiated as part of the existing agreement. In order for Warner Brothers to actually engage with Paramount, they had to get special permission from Netflix to do that. Netflix, as the incumbent, does still have a leg up because even if Paramount does put forth a higher offer or an offer that the Warner Brothers board deems to be superior, Netflix would have 4 days to match that. And by matching, that means they only have to offer exactly what Paramount has offered. They don't have to beat Paramount. By just matching, by tying, they win.
Is it fair to also say that Netflix just has more financial firepower here? Because there were questions, how much can the Ellisons really even raise their bid for Warner Brothers at this point?
And that is still one of the questions. We don't know where any additional money will be coming from. Of course, Netflix has a stellar, balance sheet, high investment grade ratings. I think one of the interesting things that arose over the weekend, or that we just learned, is that even after Paramount had put forth its amended offer last week, where it made some concessions to Warner Brothers about, agreeing to pay a breakup fee and some other things that the board had asked for, one of its bankers privately contacted Warner Brothers' board, a member of the board, and said, if you engage with us, we'll offer at least $31 a share. So I think now the question that we're all wondering is how much higher than 31 will they go? And over this next week, the Warner Brothers board will be trying to get everything in writing because of, it's one thing to say we'll offer more than 31, but if there are still issues with the documents, it's not a guarantee that this will result in a deal with Paramount necessarily.
Well, I know one of the original gripes for this was Warner Brothers calling it like the biggest leverage buyout in history, that there was so much debt. You get Larry Ellison coming in with the personal backing. But don't those concerns crop up again if Paramount's offering more money? Presumably they are adding leverage onto this deal to get them to a place to allow for it.
So, of course, adding more money is not going to help with the debt problem. But at some point, it'll be up to the board to decide how much do we care about the future of the company versus maximizing value for shareholders. Of course, they have a fiduciary duty to maximize value for shareholders, and if that means getting, a much higher price, but it's going to lead to a levered company down the road, that's something we'll have to weigh.
Where do these companies stand in making the pitch that we can better cross or we can better jump over antitrust hurdles?
So both companies, both Netflix and Paramount, have argued that they have a better shot of clearing antitrust hurdles. Warner Brothers has said it sees an equal shot for both of them. Paramount has been using an approach of touting all of its approvals that it's getting in various jurisdictions as proof that it can get this done really quickly. Netflix has been a little quieter on that front, but in their press release today, they did actually point out that one of the approvals that Paramount had gotten in Germany, Netflix had also gotten, but they just hadn't told anyone. And so they're saying, hey, yeah, we also are getting approvals the same way as you are, Paramount.
I realize that this is a difficult question and maybe unanswerable. I'm going to ask you about it anyway. If we go through the 7 days and you get Netflix, they continue to match whatever whatever Paramount puts out there. Is the 7 days, is that the end of this? Or is this a deal that can drag on beyond these 7 days?
It's the million-dollar question. Presumably, if Warner Brothers determined that it needed more time, it might be able to negotiate an extension on that waiver with Netflix. But the message they're sending right now to Paramount, and that they sent to them in a letter, is now is your time to shine. Like you've said, that you have more to offer, give us your best and final. Otherwise, we're going to move ahead. And Warner Brothers has scheduled its shareholder vote with Netflix for March 20th. So they are in parallel, at the same time that they're discussing this with Paramount, they are moving ahead, business as usual, with their plan to close the Netflix deal.
By the way, just before we let you go, I know just some of the pricing on it. It was your reporting that suggested they could go to 31, or that's the initial offer, and the best and final could be beyond that?
So what a Paramount banker had suggested to one of Warner Brothers' board members was that they would pay at least $31 a share if Warner Brothers were to engage. We don't know how much higher they'll go than that.
All right, Michelle. I can't recommend to everybody enough to follow Michelle's reporting, because you have been an absolute beast on breaking these stories. That's Bloomberg's Michelle Davis. And Michelle, I promise you will be joining me tomorrow on Bloomberg Deals. That's at noon on Wall Street time. So tune in to that to get all of Michelle's exclusive reporting. Coming up, General Mills warns of a sales slowdown despite lowering prices. That's coming up next. You're watching Bloomberg TV. You are watching Open Interest. I'm Dani Berger. Let's get a check on stocks this morning. About 20 minutes into your trading day, and we are now trading at the lows of the morning. Okay, only in 20 minutes, but this wall is decidedly matching me this morning, or I'm decidedly matching it. I apologize if I have any influence over this equity market action. The NASDAQ, it's now down almost 1%, 0.9% to be specific. The S&P falls 0.5%. It's a week last week where we fell more than 1%. It's been a struggle to hold on to any gains. A lot of chop underneath the surface, and you're not seeing that broadening out. The Russell 2000 also having a poor day, down 0.6%. The Dow is under 50K. Someone let Pam Bondi know. She'll be alarmed to hear that. Bloomberg Dollar Spot, that gains, even though the latest Bank of America fund manager survey had one of the most bearish readings in quite some time on how investors feel about the dollar. Brent crude, that's down 1.7%. It had been rallying with the talks in Geneva happening between Iran and the U.S. and threats of partial closings of the Strait of Hormuz. Nvidia, that's part of the reason that we are seeing some serious declines in both the NASDAQ and the S&P, down more than 1%. Apple, though, that's rallying after getting beat up. Dan Ives out with a note this morning saying that Apple's going to benefit from AI. People have been punishing it as if it was not participating. We're just talking to Michelle Davis about the latest twists and turns in Paramount, Skydance, and Netflix. It's the deal that refuses to go away. So Paramount has sweetened its bid for Warner Brothers, and they've reopened negotiations. Netflix has granted them a 7-day waiver for them to give their best and final offers. One of the bankers suggesting to the board of Warner Brothers that the first and at least initial bid could be at $31. They're currently at $30. And then we have the consumer giants. General Mills down 7%. Lower sales outlook. Cereal, snacks, dog food, all seeing the biggest hits. Let's bring in Bloomberg consumer editor Emily Cohn to discuss. Emily, they lowered prices, so what went wrong here?
So I think what we're seeing now is consumers are trading down. Think about the brands that are General Mills, Cheerios, other snack foods, where there are private label options that are cheaper. I think the same can be said about pet food. People are trading down to cheaper options right now. And either these are the kinds of foods that you just don't need in your pantry. They're more disposable. They're not the staples, or that there are cheaper options at the grocery store.
Even for pets? I feel like that's got to be a signal, because people love spending money on their pets and like buying the finest delicacies that their, tiny little Bichon Frise could eat.
You're so right. And I think in the pandemic, we saw a rapid rise in pet ownership. When people have more disposable income, they're likely to splurge on their pets. But that's where we're seeing people cut back now. We're seeing people cut back on the things that they don't need. Obviously, hopefully they're still feeding their pets, but they're not splurging on the brand names. They're private label options, they're cheaper options, and that's where General Mills is struggling.
So what does a General Mills do? I mean, do they keep cutting prices? Because we've seen, for example, I know it's different, it's not groceries, but McDonald's slashed their prices pretty aggressively. And then that led to a really good earnings season. Is that the tactic going forward? Keep prices as low as you can?
It's interesting, and we'll see more this week. I'm curious to hear what Walmart has to say about prices. A lot of companies have been eating the cost of tariffs for a year now, and there might not be much room for them to keep taking on higher costs and lowering prices. So, a lot of some companies in the consumer space are raising prices. So we'll see how long they can do. General Mills did say in the categories where they did cut prices, they saw volume up. But obviously, that's not enough to keep their bottom line growing.
Yeah, I guess we'll get Walmart on Thursday, right? So
Thursday morning.
See you
back here.
Bright and early Thursday morning. Also, will be interesting to see whether this is bad news for General Mills, is good news for Walmart, to your point, with some more bargains there.
Private
Emily,
labels. Yeah.
Thank you so much for joining us.
You,
Always
Dani.
great to see you. That's Bloomberg's Emily Cohn with Walmart, now a $1 trillion company, even though there are concerns about the consumer. Coming up in the next hour, Sitara Sundar talks about the AI market jitters. Then we're going to talk about private debt and leveraged tech loans with Benefit Street's CEO. And Dave Dase of Goldman Sachs is going to discuss the firm's push into sports investments and the greater landscape for that. All of that coming up in your second hour of Bloomberg Open Interest. 30 minutes into your trading day, welcome to Bloomberg Open Interest. I'm Dani Berger. Matt Miller on a well-deserved break this week as equity markets sink on the lows of the morning, down nearly 0.8 for the S&P 500. Coming up over the next hour, investors shun software stocks on AI fears. Fund managers warn that the worst may not be over. Anthropic and the Pentagon hit a snag in contract talks over mass surveillance and security concerns. Plus, oil swings as signs emerge that the U.S. and Iran are making progress on nuclear talks. We begin with AI worries on Wall Street fueling a software sell-off. Sitara Sundar, head of alternative investment strategy at JPMorgan Private Bank, sees a potential $6 trillion opportunity by the end of the decade. Writing, we are in the early stages of a shift from software as a service to services as software, where traditional labor-intensive business services evolve to being delivered through AI-powered software platforms. And Sitara joins us now. I love that you're finding the silver lining of everyone else freaking out. So many things have been selling off. So what is the opportunity? How do you sort of see software shifting among AI?
Yeah, I think that first, thank you so much for having me. It's lovely to be here. I think that what we're finally seeing in the market is this trend that we've been talking about really for well over a year now, which is a different definition of SaaS and shifting from this idea of everything needing to be done from software as a service, subscriptions, recurring revenues, and things along those lines, to this idea that the disruption that we're going to see is going to broaden beyond just the tech sector. And it's going to disrupt what we're seeing as legacy labor-intensive services sectors. So we're finally seeing and come to fruition this idea that the ROI in artificial intelligence is disruption. So what does that mean? It means three things. It means agentic AI, so thinking about having a co-pilot next to you and a digital co-pilot. It means AI-enabled horizontal software, so think about your normal CRMs, but adding an additional AI layer on top of that. And it means vertical AI tools, so think industry-specific, legal, financial services, healthcare, all of those areas that have had information systems that have been built in the dark ages, like 20, 30 years ago, that are going to become digitized.
Do the incumbent software companies succeed in that environment, or do they get replaced?
I think that it's going to be a mix of both. Like, honestly, if I think about what's happening in the public markets right now, I think it's a short-term overreaction, but long-term right. So what does that mean? I think that there are a few factors that we're thinking about in the software companies that are going to be safer. For example, are you thinking about whether or not your process is truly embedded and ingrained in the overall end-to-end system? How deep are your partnerships? Are you really providing proprietary insight, or are you just gathering information? And the final thing I would note on this is your recurring revenue model seat-based or is it usage-based? Because if it's usage-based, you're likely going to be safer because productivity increases will lead to more usage, which will lead to higher revenue. Whereas if you're seat-based, if more and more areas of services end up getting automated, that actually might reduce the amount of revenues that you have because the number of subscriptions actually will end up going down. So when we think about the future, when we're looking about those durable business models, they need to have deep partnerships. They need to usually be a usage-based model. And the final point is that the models that are the information that you're actually going to be providing and needing, what level of accuracy and trust is needed within that? Because I think the other thing that maybe the market is missing at this point in time right now is whether or not the adoption of artificial intelligence is going to be more akin to the iPhone, where it was used as a productivity enhancer for human beings and therefore was adopted immediately, or is it going to be more like the adoption pace of gene editing and autonomous vehicles, where you need 100% accuracy, you don't want to be editing your genome improperly, or who is accountable at the end of the day? Who is accountable to the decision that that agent ends up making? So the ultimate thing for investors is that the entire proliferation of artificial intelligence, all that we've seen in AI fueling this market for the past 3 years, the ROI stage is here. And what that means is that there's some legacy players that are going to be disrupted, but at the same time, to that silver lining point, there's going to be meaningful opportunity. And for me, sitting with my alt hat on, a lot of that innovation is taking place within private markets.
Can we just go back to that iPhone metaphor? Because
yes.
I love that. I think that is so incredibly well put. But what are you seeing among companies now? Because there does feel this real push that you need to stay relevant. You need to be investing in AI. So are they just doing it, adding an iPhone in all of their employees' pockets? Or are they being thoughtful about it? And are they really making real returns and being careful and being selective? Which part of the stage does it seem like we're in right now?
I think we're somewhere in the middle. I think there are going to be companies, and we've seen it, that are attaching artificial intelligence to an archaic system in which AI is actually not going to be able to make it more productive. But on the flip side, I think academic research is a little bit mixed on it, but we are actually starting to see tangible improvements from a productivity perspective and a EBITDA growth perspective and a margin perspective in a handful of areas that are actually reworking the end-to-end workflow and thinking about things from an AI native perspective and not just using their legacy system and trying to put artificial intelligence on top of it. And I think that bifurcation and that delineation will start to prove itself out in public market pricing soon.
Well, one of the things that I really struggle with are some of these sectors, just take commercial real estate, which had a very bad week because the idea being more AI, less workers, less need for office space, so commercial real estate doesn't do well. Presumably, if we get to that point, there are going to be bigger worries than like how commercial real estate is varying. It feels like the end point to when we discover whether or not these things actually come true. Like we're talking really big societal changes. So how much conviction can you really have in some of these trends and some of the disruption trends when it might take a while to discover what it actually looks like?
Look, I think that's the number one question, both philosophically and also from an investment perspective that we're all grappling with. What do you do when the idea of intelligence becomes a commodity? What does the democratization of intelligence actually mean for all of us? But from taking a step back from an investment perspective, every tech and disruption cycle ends up this way. You see a period of time where there's a lot of investment in building the infrastructure, which is what we've seen over the past couple of years. And then you're in this digestion period, which is where we are right now. Who are truly going to be the winners and who are going to be the folks who are left behind during this period of time? I think for us, it means a couple of things. One, it means that you need to be diversified from a exposure perspective, having exposure to the infrastructure players, which are primarily the hyperscalers and utility players within public markets, infrastructure, power infrastructure in private markets. And you want to start adding exposure to the application layer, but in a diversified way. Manager selection could not be any more important now than it has been over the past 5 years. So that barbell approach between infrastructure and application layer, and then outside of that, building durable and resilient portfolios. 50% of U.S. equity markets now are within tech. We're looking for geographic diversification, sector diversification, and to your point on real estate, just to bring it full circle, real estate is more than just office as well. Industrial real estate actually will end up benefiting from some of the investment that we're seeing on the power side and on the manufacturing side. So ensuring exposure not just to the areas that are going to win, but the areas that are more insulated, like core real assets, like even hedge funds in this period of time, where we're looking and trying to find less correlated, diversified return streams so that if something does end up going bump in the night, your portfolio will be resilient no matter what.
I could literally talk to you about this for hours. This has been so thoughtful. Thank you so much for joining. Really appreciate that. Sundar of JPMorgan Private Bank. Let's get a check on your equity markets. Nearly 40 minutes in your cash equity trade. We are still putting in losses this morning, down 1% for the NASDAQ 100. We've been down for 3 consecutive weeks with a equal weighted index just inches away from record highs, but it's a struggle of a day this morning as 10-year yields go a whole lot of nowhere. We're currently at 404 this morning. Brent crude, that starts to drop 1.4%. It had been rallying with the threat of Iran partially closing the Strait of Hormuz, but there does seem to be some progress in talks between Iran and the U.S. We're going to discuss that at the end of the hour, exactly where we are. Let's look at some of the single stocks that are on the move this morning. Warner Brothers has agreed to temporarily reopen negotiations with Paramount Skydance. It sets the stage for a potential second bidding war with Netflix. And now Netflix shares are losing. They're down 2%. Interesting, because Netflix usually have been gaining when there were hopes that maybe they wouldn't do this deal, because they'd also get a breakup fee. But anyway, shares are down. Paramount significantly up this morning. We're also watching shares of Norwegian Cruise after activist Elliott announced that it has built a more than 10% stake in the company. They're up 8%. And in other activist news, Starboard has delivered a letter to TripAdvisor urging a board overhaul. And the sale of the company, shares up 6.6%. Coming up, we're going to talk credit markets with David Manlowe, CEO of Benefit Street Partners, a Franklin Templeton company that manages $92 billion in assets. A conversation you don't want to miss. Stay with us for that on Open Interest. Bank of America's latest fund manager survey found that a record number of investors are concerned that companies are spending too much. Meanwhile, 30% of participants said that capital expenditures on AI by the big tech companies was most likely a source of a credit crisis. Joining us now to discuss is Dave Manlowe, CEO of Benefit Street Partners, a Franklin Templeton company that manages $92 billion in assets. And of course, that comes from private credit. So you're the perfect person to ask about this, David. First of all, thank you so much for joining us
Dani,
this morning.
thank you for having me. Really appreciate it.
And these big tech players are increasingly turning not just to public markets, but private markets too, to fund their infrastructure build out. Is this a real concern? Should it be a concern, maybe that they're overspending and private credit players are getting more in the action?
Yeah, I actually think it's an opportunity. If you look at the Bank of America survey, there's been others out with the amount of debt capital that needs to be part of the financing stack for AI, that you are going to see a tremendous need for capital, and private capital and the liquid capital markets, credit markets, are going to be there to fill that gap. And whenever there's a gap, and it creates opportunity for excess spreads. And we do not believe that the spending that you're seeing is ill-fated from a return standpoint, that you are going to see returns from AI, and that is going to create a great opportunity for investments going forward. And then if you think about kind of the knock-on effects of that, is that's going to open up opportunities in, for example, where we lend into the core middle market. Mm-hmm. So if capital is migrating to these large data center deals, so on and so forth, you're going to see the opportunity to lend to the companies that are ultimately going to be applying the AI or being part of the build out, which just, again, creates opportunity for private credit going forward.
There is this irony in the trade that's happening right now, because on one hand, people are saying, oh, there's a bubble. And then on the other hand, it's AI is so amazing and so great, it's going to disrupt things like software. Software and credit exposure has been a huge sticking point. How many of your LP calls have just been what's your software exposure and is everything okay?
Well, you've hit the nail on the head. It's like the starting point of every single call. And I kind of joke about it because it was the second half of last year where I did a number of panels. And the panels, every one of them were two subjects, AI and private credit, which I never thought as a debt person that we'd be in something so sexy as AI. But I think the reality is that the application of AI and the return that it's going to generate is all about opportunity. And then if you look at software, for example, I thought your prior guest was terrific in analyzing that. What you're seeing is everything is being sold initially, whereas this disruption, I think, is going to create volatility and it's going to create dispersion. And if you think about what we do as asset managers, it's all about credit picking and stock picking. So the value of active management, I would argue, on the back of AI and clearly going to be disruptive, but the opportunities on the back of that disruption is the premium on active management is going to go up dramatically, because there really will be winners and losers, as what I think pretty well identified.
So how many of what sort of percentage are you looking at a portfolio of companies that exist in software, and what are you doing with them right now?
Yeah, so right now we are very underexposed to technology and software. About software, for example, globally for us is about 5% of our portfolio. In the US, it's about 9%, which would be about half the index. And I would love to tell you that's because we had this unbelievable foresight about AI, but really it's because we are very conservative investors. So when you think about some of the software lending that has occurred, it's generally been more revenue-based than cash flow-based. And I'm not saying those are bad loans, but for Benefit Street Partners, we've been very cash flow-based in our lending. And as a result of that, we have been significantly under-indexed, which is obviously paying dividends for us today, both in software as well as technology.
When it comes to the overall private credit market, I had a conversation with John Gray to start the year, who basically just said it's mathematics. Rates are coming down, so returns are also going to be compressed. How do you stand out in an industry which has been extremely popular, has seen a lot of managers start to create funds and fundraise, and dry powder's really high? How do you stand out when the entire industry returns do just get squashed down together?
Yeah. Well, so first of all, what I would say is returns in private credit, the dispersion amongst managers, the top managers, has been pretty tight over the last, you name it, 5, 10, 15-year period. And I think what is allowing you to stand out now is, and we just recently, as we talked beforehand, did a survey, is you need as a GP, you need to have comprehensive capabilities within private credit, both your geography in which you are lending, but as well as sort of the sub-products. People paint private credit with, a single brushstroke, but today it's horizontally expanded from direct lending to asset-based finance, which is sort of the hot dot these days, to commercial real estate debt finance, which has been a big area of growth for ourselves. So the way you're going to stand out with your investors is you're going to be diversified from a horizontal standpoint in terms of the subcategories of private credit. You're going to be diversified geographically, and you're going to be diversified in terms of the size of company, the size of opportunity that you're lending into. And having all those dimensions and scale makes a difference. At scale, I think, is what's going to really define the winners within private credit, going forward.
Dave, we're going to have to end it there. Thank you so much for joining this morning. Wonderful to see you. David Manlowe of Benefit Street Partners. Now let's get to high interest, a look at what's making headlines around the world. A sweeping leadership shakeup at crypto exchange Gemini. 3 top executives have left the firm founded by the Winklevoss brothers. The exits come after the company said earlier that this month it plans to cut as much as 25% of its workforce and wind down operations in the UK, EU, and Australia. Goldman Sachs planning to remove diversity criteria from how it selects board candidates. That's according to the Wall Street Journal. The move follows pressure from a conservative nonprofit and comes as major banks scale back their own DEI policies. Goldman has already dropped diversity targets and ended its pledge tied to the makeup of its board and its IPO clients. Jesse Jackson, the civil rights leader who carried Martin Luther King Jr.'s mission into presidential politics, has died. As the founder of Rainbow Push, Jackson ran for president twice, pushed corporate diversity, and negotiated hostage releases abroad, remaining active even after a Parkinson's diagnosis. Jesse Jackson was 84 years of age. Anthropic's contract talks with the Pentagon have hit a snag over AI guardrails. The company wants limits to prevent mass surveillance or autonomous weapons use. The Pentagon, meanwhile, says it should deploy the tool as long as it follows the law. Let's bring in Michael Shepard, Bloomberg senior editor for technology and strategic industries. Shep, what does it mean for as long as they follow the law? Is this a real threat that they could use it for mass surveillance and autonomous weapons?
That is one of the big questions that Anthropic is raising in these negotiations by seeking those very assurances. And it has seen, as we have all seen over the past year, the Pentagon has taken liberties in interpreting the law in its interdiction efforts against narcotics trafficking in the Caribbean and in the Pacific that many observers have said falls outside the boundaries of military law. And in that context, Anthropic is raising these sorts of questions. And for this technology, for artificial intelligence, the use in a military application on a battlefield even is undiscovered territory. This is a new area, and they are all trying to feel their way through. And for Anthropic, this is a move that is very much on brand, Dani. They have pitched themselves as a safety-conscious technology, as a safety-conscious approach, and this is something that they have made really part of their identity, really separate from what a number of other AI companies have done, which is forging ahead with the technology. But Anthropic has made that sense of trying to avoid catastrophic harms from using the technology, whether it be in war or elsewhere, is really something that is critical to its identity. So having this sort of a confrontation with the Pentagon, a negotiation with the Pentagon, is really critical. Now, the question is what the Pentagon decides to do if they will ultimately pull the contract. Now, Claude Gov, their special product designed for use by military and intelligence agencies, this is something that has gotten some pretty big uptick across the government, and we have seen Claude more broadly as an enterprise product adopted quickly across industry. So it'll be interesting to see where this ends up. The Pentagon is warning that the relationship is not only under review, but a defense official says that they now see Anthropic as potentially a supply chain risk. The company is saying that it will abide by the law and by all ethical norms and codes that it follows, but we're going to have to see where this ends up.
Again, it just feels very dystopian we're having this conversation, Shep, but thank you for having it with us. That's Bloomberg's Michael Shepard on the latest with Anthropic and the Pentagon. Let's get a check on your equity markets. I'm getting a lot of viewers writing in about how I match the markets. I swear it's not my fault. It's not my fault. The market tells me how to dress. We're down by 1.1% for the NASDAQ 100. The S&P falls 0.6%. Still, it is tech that's getting beat up. 3 consecutive weeks of losses. Coming up, Lancôme betting on longevity science to power its next phase of growth. We're going to discuss with the company's global brand president. That's coming up next. L'Oreal's latest results showed weak sales growth with its luxury division, which includes Lancôme and Yves Saint Laurent, hurt by softer travel retail demand in Asia. In an effort to help reignite momentum, Lancôme is doubling down on innovation by launching a new longevity-focused skincare range. Here to discuss with us is Vania Lacascade, Global Brand President at Lancôme. Vania, thank you so much for joining us. So with this, you've partnered with a Swiss biotech company, Timeline. There's so much in this sort of realm of anti-aging and longevity. What sort of benefit, what edge do you have by teaming up with this Swiss biotech company?
Hi, Dani. Very pleased to be with you to talk about this breakthrough partnership with Timeline. So this is for us a decisive step in our commitment to longevity science. It really reflects our open innovation strategy. You know, we think that today innovation is collective, so we are backed by our 4,000 scientists from the R&I of L'Oréal, but we are also actively building an avant-garde ecosystem by partnering with the most advanced scientific pioneers. And yes, this is our biggest scientific leap since Genetic Serum in 2009. Longevity is a societal revolution. Women want to live better, not just longer, and this is a massive opportunity for Lancôme to lead this new territory of growth. So it's a multi-year growth opportunity for us.
So when I think longevity, I think about disease prevention, again extending lives and making them more livable. Vania, what is the line between that and just like anti-aging, something that's been marketed towards women throughout the history of time and is often, over-touted its benefits? Well, what is the line? Because I see you're specifically marketing this as longevity, not anti-aging.
This is longevity, and longevity is not a trend. It's a real scientific reality, and obviously we are entering the field of beauty. Beauty has a role to play in longevity because it's the first thing that you're saying. If the science works, then you can see it on your skin. So the way we approach it at Lancôme is that for us, longevity is this proactive, science-led, data-driven approach that acts at the root of the aging mechanism. So the way we've developed this new initiative is 3 ways. First, we have the asset. You always talk about asset in Bloomberg. Our asset is MitoPure. This is the molecule that is within the longevity supplements by Timeline. It's 15 years of research, 30+ patent. It's over 50 million in R&D, and this is You can think of Matopure as a kind of, let's say, a cellular reboot. It helps the cells clean up, recharge, so that your skin can behave, look years younger. And
but Vania, if I can just jump in, why is that longevity and not anti-aging?
Longevity, because it's acting at the root cause of aging, which means that it is able either to anticipate, to intercept, or to reverse your skin biological age. So this is the only age you can reverse. Your chronological age is the one you have, is the number of candles that you have on your birthday cake. But the skin biological age is the one that you can reverse. So actually, you can have a much younger biological age than your chronological age.
Where can you price this at? I know there's some concerns about the consumer. Your parent company, some of the results, as I mentioned, weighed down by lack of travel, especially in areas like China. So are people willing to pay up top dollar for this type of product?
For us, the data that we have is that luxury is evolving, but it remains incredibly resilient when it's driven by high value innovation, by performance. We see a clear shift from discretionary spending to investment spending in health and skin. So the luxury consumer wants efficacy that they can actually measure. So we are providing them a high value skincare to manage their skin visible biological age, which is exactly what the premium consumer is looking for right now.
At what point does prestige skincare, though, Vania, hit a ceiling?
I would say that for this range, we are proposing a price that is the most accessible of our absolute premium range. So this is for us a sweet spot that is able to provide to the consumer a proprietary formula, a delivery system, a key innovative ingredient in the most sensorial luxury skincare formulas.
What about Lancôme as a whole, Vania? Are you still seeing appetite? How does the consumer look to you at this moment?
I think that Lancôme has always been this powerhouse of progress, and I think that investing in longevity science is the right move for us, and we are doing it in a very bold way. I think that you've seen that we've already made some partnership by the past. We've launched last year longevity PDRN molecules that is already showing that we can act at the biological level of the skin. We have also partnered with Timeline with NanoEntech, which is a Korean startup that allows us as well to have this fantastic new diagnosis. It's called cell bioprint. I don't know if you're familiar with it, but it's a kind of a lab on a chip. It's using microfluidics to really measure the proteins of the skin. And this is the way we can really measure now the skin biological age. So it's something that will really help us make the consumer understand what is the added value of our innovation.
Vania, I mean, just on that, South Korea feels like it's become this hub for skin tourism. If everyone going there, getting the latest injectable, the polynucleotide, what have you. Why does it feel like this is a region that's just so far ahead and so advanced, especially if you compare it, not in Europe, but especially America?
You know, as I said, innovation today is collective. It's coming from everywhere. The US is moving very fast. The longevity trend has really boomed in the US. We have all this medical community that is ramping up on the science. Asia is also very active. I would say that yes, Korea, but not only. So we are getting all the collective passion and energy from all those zones to be able to provide the best innovation program that we can on the brand.
Vania, thank you so much for joining us this morning. That's Vania Lacascade of Lancôme. Let's get a check on your equity markets this morning. Still in decline, now down 1 1/3% for the NASDAQ 100. It's been declining. The safety things are what's been working over the past couple of weeks. Utilities, staples, all of those have been doing pretty well. Brent crude, now that's falling pretty rapidly, down 2.5% with some hopes of progress being made between Iran and the U.S. in nuclear talks. Again, 10-year yields will change this morning. Let's take a look at some of the single stocks on the move this hour. General Mills lowered its 2026 sales outlook. Shares getting pummeled, down 7%. It cited a more challenging consumer environment. We'll get Walmart sales on Thursday. We'll see what they say. Danaher, they've agreed to buy U.S. medical technology firm Masimo in a deal worth almost $10 billion. And we're watching shares of Fiserv. Sources telling Bloomberg that activist investor Jana Partners has a stake in the company and is now pushing for changes. Shares up 4%. Coming up, more and more private capital firms are making a push into sports. We're going to speak with Dave Dase, global co-head of sports investment banking at Goldman Sachs. Stay with us for that conversation just on the other side of this break. Sports investing has become the hot new thing among private capital firms. KKR recently doubled down on its sports by buying Arctos. With Apollo Aries, they also have announced major investment plans in the space. Let's discuss with Dave Dase, global co-head of sports investment banking at Goldman Sachs, alongside my Bloomberg Deals co-host, Scarlett Fu. Great to see you both this morning.
Thanks for having us.
Dave, the cynic's view of this push could be they're all adding in retail capital. It's a lot of dudes who like sports. It's a lot of investors or LPs probably like sports. Maybe their returns aren't so good, but it's like a sexy, flashy topic. What is sort of the counter to that narrative of why this actually makes sense for private capital to push into?
I think it makes tremendous sense. You think about sports, it's $1 trillion plus asset class, right? It has very little outside capital, which has come into it. And if you look at historical returns over time, these have been very strong returns. They've generally been uncorrelated with other asset classes. So the investment thesis is very, very strong from that perspective. And then you look at the content of sports and the fan engagement and the repeat nature of that, and how it's not only the fan, it's the family, et cetera. Very, very significant. And increasingly with direct to consumer, you have the ability to drive this on a truly global basis. And so you think about addressable market and what that total fan base could be for different leagues, different teams, quite frankly, even players. These are really global businesses today, and we're just at the beginning stages of what that can really look like.
With the entry of private capital, that means that valuations can go even higher. And there are a lot of questions about whether valuations are already too high. How do you go about breaking down the answer to whether valuations are in bubble territory?
Well, it's interesting. As we think about the different pockets of capital that are interested in investing, right? You have your traditional owners, so your billionaires. More billionaires are getting made at a faster pace today than I think any time in history. You look at family offices. You've talked a lot about family offices on your shows. That's growing very, very dramatically. And so across our business, we're seeing significant interest out of these family offices, some for a passion play, which you talked about, some just for pure asset allocation into a really good asset class. And then you have the private equity firms, which you talked about, 15 to 18 or so on a global basis, probably 50 to 100 billion dollars of capital that wants to go in. But again, on $1 trillion industry, $1 trillion plus, it's not that much capital which is going in. So we think there's tremendous interest. From a floor perspective, media rights continue to be strong. You see in the best leagues around the world, the best unique content, those continue to go up at a pretty dramatic pace. And we talked, and we can touch more on, but this direct-to-consumer model and how do you think about the monetization of the fan and that community building around that fan base is very, very strong. So we think there's significant opportunities. Sports have also historically been funded more pure equity. So the loan to value has been relatively low. And so over time, as this evolves and you continue to see more innovation, we think there are opportunities to drive down the cost of capital pretty dramatically as well.
In the U.S., though, it's already a very mature market, and Arctos is really the only fund that has approvals and ownerships of all of the big leagues. Does that mean liquidity is a problem? If you buy into this, are you sure you can get the valuations you want if you want to exit the investment?
It's a fantastic point. Secondary liquidity is critical to this. It's critical to every other asset class. It's very limited today, as you touched on. And so we're going to continue to see more innovation, more openness. Leagues are going to probably be more open in terms of how this works. From a Goldman perspective, we think that the evolution of this will be similar to what we've seen in other asset classes over decades, and it'll move more in that direction. But it's a very good point, because today, secondary stakes still fundamentally trade by appointment, and they're highly illiquid. But it's getting better. It's come a long way in the last 5 years, and we continue to see this evolution. And everybody's aligned to want this secondary liquidity to come. We talked about all the pockets of capital that want to come into the sector. Certainly, if you're in this sector, and there are certain pockets of capital that only come in if they feel they can get out at a true market-based price. And so that's their path here.
Which part of the sports investment landscape do you see secondary liquidity happening the fastest? Is it going to be in the established leagues or the niche sports?
I think it'll be both. Certainly, the broadest pockets of capital tend to have an interest in the biggest leagues, the best content, the biggest companies, right? And so I think we'll see that liquidity drive over time, and that's where you could drive to more liquidity at scale. The nascent leagues, the high growth leagues, there's huge opportunity. Valuation is important, but we think there's really attractive opportunities in that sector as well.
How are you advising people when they want to buy some of the more niche sports, to Scarlett's point? Like, I've spoken with Mark Lazary of Avenue before, who I believe has a stake in Sale GP, and I look at something like that and I'm like, what is the audience for that? How do you grow that? What are the media rights? So when you have these more niche sports, What does the path of growth look like?
We talked a little governance. So I think governance of the league, how's it controlled? How are decisions made? Are those decisions made for the betterment of the league and all the teams of the league? Or is it everybody just going aggressively after each other? You need to have that competition, but more of that competition on the field or on the water in CLGP cases. So I believe that's really, really critical in terms of what you do. And then valuation, what's the addressable market, right? We talked about that. How big is that fan base? What does that fan base look like? SailGP, smaller addressable market for sure, but you think about that fan base and what the profile of that consumer looks like and the economic profile of that consumer, highly, highly attractive, right? So to certain brands who want to get access to that type of consumer, very attractive, and the league's done tremendously well.
Let's talk about a direct-to-consumer market and what that's going to look like in 5 years and 10 years from now with, say, something like the NFL versus something like just a pickleball league.
Yep, direct-to-consumer. Look, there's been no better time to be a fan today of any type of sport. And again, it goes back to, in the old days, you had to go to the stadium, right? You probably were in the region. Then you had broadcast television, but now you can be anywhere on the globe and be a fan. And this community element of being social, being attached, having this curated audience, and for those teams and these owners now having this first-party data to know if you have 10, 20, 50, 100 million people in your database, you know everything about every single one of them. And so the ability to engage them in a way that makes their experience better is very, very significant. And the next evolution of this is going to be more tools in an AI world are going to get pushed out to the fan base so they can curate. You can now get your own customized sports center, right? But you can curate your own highlights. You can do this in the way you want to do. And I think increasingly you'll see television angles where if you're watching a game, you can say, look, I'd like the quarterback cam, or I'd like the catcher cam, or I'd like this different cam. And so you're almost going to be your own producer, and that's just going to drive more and more active engagement into the sports world.
Yeah, I know, like F1 already does that. You can pick your driver
right.
of who you see behind the wheel, which is wild to me. On the other side of things, you have extreme fans and extreme fandom in Europe. And you also then have the risk of delegation for European football teams. And this has been a really popular investment for a lot of not just private capital, but for billionaires too in the US and otherwise. How should an investor weigh up the risk of opportunity of these clubs when you can also have serious financial consequences if your payoffs don't result in staying in the league, or maybe you see delegation?
Well, it's not a surprise the NFL and the NBA have the highest team valuations in the world, and it's for this reason, right? Certainly European soccer has massive fan base, in many ways bigger fan base today on a global basis. But that relegation risk, the lack of a salary cap, a business model where there's a lot more volatility in the business model versus in the NFL case having a hard cap. In the NBA, it's in essence a soft cap. They got through the last collective bargaining agreement. And so it's a huge, huge impact in terms of how you ultimately think about this. And every sport is different, but ultimately it comes back to that governance and what's been set up.
The Paul Allen Trust has tapped Latham and Watkins to lead the sale process for the Super Bowl victors, the Seattle Seahawks, along with its pending sale of the Portland Trailblazers. How do you see this shaping out? Like, how do you see this playing out over the next couple of months?
Well, I think it's hard to comment on any specific situation, but the fundamentals for sports, writ large, certainly the fundamentals for the NFL continue to be very, very strong. And so we'll see what ultimately plays out here if they decide to move forward or not.
Will be definitely interesting to see. Dave, thank you so much for joining us this morning. That's Dave Dase of Goldman Sachs. And of course, Bloomberg's Scarlett Fu. And tune into Bloomberg Deals, that show tomorrow at noon, where Scarlett and I will walk you through all the biggest deals happening in this market. And there are a lot. Coming up on the show, Iran and the U.S. edge closer to a nuclear deal. We'll have the details for you next on Bloomberg Open Interest. Let's take a look at what's ahead for markets this week. Today, we're going to get some Fed speak. That comes from Michael Barr and Mary Daly. Tomorrow, the latest Fed minutes and durable goods. Thursday, earnings from Walmart and another round of jobless claims. Then on Friday, we have core PCE and University of Michigan sentiment, plus a potential Supreme Court ruling on President Trump's tariffs. They've declined to rule on that so far. We'll see whether we get it this week. We're also watching Iran-U.S. nuclear talks. Iran says it reached a general agreement with the U.S. on guiding principles for a potential nuclear deal. Let's get the latest Bloomberg Washington correspondent Tyler Kendall. Tyler, the talks taking place in Geneva. Where do we stand?
Yeah, hey, Dani, good morning. Well, this is considered to be relatively positive diplomatic progress, but we also have to keep in mind this is coming from the Iranian side, and at the moment it sounds like we have just agreed to keep the talks going. Now, even if this is positive, we have to just keep in mind that we still haven't seen another date set for a potential third round of talks between the U.S. and Iran, as the second round wrapped up today, led by Special Envoy Steve Witkoff. We also saw Iran's foreign minister yesterday meet with the UN atomic watchdog. The main question that is currently at hand is whether or not Iran is going to be able to maintain any domestic enrichment capacity when it comes to its nuclear program. That appears to be at the crux, at the center of where these negotiations stand at the moment. The thing is that we have repeatedly heard from U.S. officials, perhaps most notably the Secretary of State Marco Rubio, that the U.S. needs to see this agenda expand beyond nuclear. They also want to see put on the table discussions around Iran's ballistic missile program, as well as its support for proxy militia groups in the region. In fact, our own analysts at Bloomberg Economics say just focusing on the nuclear file is not going to be enough for the Trump administration, which is why they maintain in their assessment that there is still this high likelihood that the U.S. could take military action against Iran. There are just so many factors that we should be looking at the moment, not the least of which is that we have seen this bolstering of U.S. military assets in the region, as the Trump administration has confirmed it has sent over that additional carrier strike group to the Arabian Sea. And we also heard from Iran earlier today that they were closing down part of the Strait of Hormuz for military drills. So, Dani, there's a lot to watch here. President Trump himself maintains that diplomacy is the top agenda item for this administration. He told reporters on Air Force One yesterday that he will be indirectly involved in the talks going forward, in his words.
What is the potential threat at this moment to disruption of shipping routes, Tyler, with that partial closure of the Strait of Hormuz?
Well, at the moment, our analysts aren't overly concerned with this one, Dani, though it does mark what is the latest move of escalation in the region, even as we see diplomacy take center stage if you listen to both sides. Rather, this is something to watch closely to see if it escalates more from here. It is our understanding that it was closed down for a few hours for these military drills, supposed to be part of Iran trying to show use of force against U.S. threats when it comes to potential military actions. It's really interesting. If you dive into our Bloomberg Economics analysis of exactly what can happen, they say that even if the U.S. military does decide to do a strike, it doesn't necessarily mean that we will see lasting impacts on the oil market. Of course, we're getting ahead of ourselves. Nothing has been decided as of yet. But let's say that there is a strike. It is really important to watch what those aftermath consequences would look like, including how Iran would choose to retaliate. And if we look at what happened last summer in June after the U.S. and Israeli strikes in what was dubbed Operation Midnight Hammer, that could maybe serve as a guidepost where both sides decided to avoid energy infrastructure. So it's going to be signs like that that we're watching closely as the situation evolves.
Tyler, thank you so much for your reporting this morning. That's Bloomberg's Tyler Kendall. As oil falls more than 2.5%, with delegations from those talks in Geneva saying that they've reached a broad outline of an agreement to continue talks. So we are off the lows of this morning. The S&P is down 0.5%. The NASDAQ 100 down 0.8%. But man, it has been tech that's been beaten up really significantly. Software has been hit. It's every single week. It's a new segment. What's going to be the disruption from AI? Brent crude, that's down 2.5%, as we just mentioned, those talks with Tyler Kendall. Yields going a whole lot of nowhere this morning. They have been declining for the most part, but your 10-year yield staying steady at 404.26 this morning. That does it for open interest. Bloomberg Tech will take things from here.